The total cost, so total revenue minus total cost is the profit formula. So can you calculate? What is the answer? So your sale price is 275. Oh, sorry, no. Your sale price is 95. Your cost is 100. So it's already a loss. You don't need 5 minutes. You just need 1 second. That's it. The answer would be A part, because none of the options have any loss. Sometimes you need your smartness rather than your intelligence. So we know that the market price is 95, our cost is 100. So it's a loss situation. So there is only one negative here. It means the loss is only, if you can calculate that, answer would be A. Right? Okay. So since we are now basing our discussion on controlling the cost, minimizing the cost, so let's talk about the different types of costs. So in economics, we assume cost as opportunity cost, especially total opportunity cost as total cost. So let's talk about this. So a firm's cost of production includes all opportunity cost of making its output of goods and services. So there are two types of costs which we talk about in economics. One is called explicit, implicit. Explicit, you can just remember that you can say that expressive, which you can express, and which is hard money, which going out from your pocket, cash outflow. Actually, cash is going out from your pocket. That is your cost. You pay for your workers, cash is going out, cash outflow. Paying for sugar, we are, going to the cookie factory. They are making cookies. So paying for flour, sugar, workers, rent, right? These are outflow of money, hard cash involved, right? Implicit cost, which is implied, which is a cost, but no cash outflow is coming out from your pocket, right? You don't pay, but it is a cost. We call this opportunity cost. For example, payment of Helen's skill if she works somewhere else rather than her own factory. So the illustration is Helen, she opened a cookie factory, right? What if she worked for somebody else and can earn $2,000 rather opening her factory, but she already started her factory. So that $2,000 is not hard cash. Rather, it's a lost income, right? But no actual cash is involved. So we call this implicit cost or opportunity cost. Right, guys? Which we cannot express in monetary terms. Sorry, which we cannot express in monetary cash outflow terms. We express it in $2,000, but that is not going out from our pocket in hard cash, in physical sense, right? So if you understand this concept, explicit and implicit, please answer this concept checker. Gustavo, you also participated.
Yes.
What is the answer?
A.
Foregone investment opportunities.
For me, it's A also. Sir, can you hear me?
Yes. Good, Karan. Answer is A. Well done. What about this? An example of explicit cost of production would be Gustavo. You answer this question.
Okay, I'm ready. I will say C.
Well done. Because A, foregone labor earnings, right? Lost opportunity, second. So this is just implicit. Well done. What about this, Piranan? Which of the following is an implicit cost?
Only the first one. C only. C.
Well done. Okay. So we just talk about the costs, implicit cost and an explicit cost. So it means if economic cost is different, then economic profit is also different. Right? In normal sense, we don't include the lost opportunity or something, right? We don't include that one. So it means if we included that one, it means economic profit is different, accounting profit is different. So economists, they measure firms' profit as total revenue minus total cost. And total cost means includes both explicit and implicit. So we call this total opportunity cost. Total opportunity cost is equal to implicit plus explicit cost. While the accounting only include explicit cost. So accountants measure accounting profit as firm's total revenue minus only firm's explicit cost, whereas economic profit only includes both. Economic profit include both costs. So when total revenue exceeds both explicit and implicit, the firms earn economic profit. So whose cost is greater? Economics total cost is greater. Why? Because it includes implicit cost as well. So in that sense, economic profit is smaller than accounting profit because in accounting profit, accountant only deduct outflow, which is explicit cost. So Helen's lost income or opportunity cost is not deducted while calculating the accounting profit. Understand? The economic, if we want to calculate the economic profit, formula would be economic profit is equal to total revenue minus total opportunity cost, include explicit and implicit cost, while accounting profit only includes total revenue minus total cost, which includes only explicit cost. So that's why accounting profit is greater than economic profit. Yes.
I understand, but please go slower a little bit.
Okay, sure. So if you see on a flow basis, how economists view, so he deduct from revenue, explicit cost, implicit cost, and find out the profit here. While accountant only deduct explicit cost. So you see here. So And like I told you, the economists consider implicit cost and explicit cost as total opportunity cost. So remember, when we talk about implicit cost, if the question simply says opportunity cost, it means we are talking about implicit cost. Foregone investment, foregone opportunity, that is implicit cost. When the question says total opportunity cost, we include both explicit and explicit. Understand? Okay, if you understand, please answer this concept checker. Mirko.
Will never exceed accounting profit.
PD, you agree? Why? Because economic cost is always greater than accounting cost. Well done. Now answer this question. And that is very interesting scenario as well. So we are having a practical example here. Let's just discuss that. So let me read it. Joe wants to start his own business. The business he wants to start will require that he purchase a factory that costs $400,000. Joe currently has $500,000 in the bank, earning 3% interest per year. Right? Okay. Scenario 1. If Joe purchases a factory with his own money, what is the annual implicit opportunity cost of purchasing a factory? You tell me. Can you calculate? What would be the answer?
I can try.
It's easy. What is the, if he purchased the factory, right? What would be its implicit cost? What he has lost between these two alternatives?
He lost the 3% interest per year.
Exactly, the 3% interest on the amount that he would be earning if he has not opened the business. Ferdinand, you understand?
Again, please.
Okay, so he has two options. Factory earn